Y'all do realize that people that go to work every day pay about 51% in taxes.
Want to hear like him elaborate more on the S-Corp LLC thing, and are we going to get more into like strategy as far as it goes from flipping to wholesaling to like contract flipping and things of that nature?
So as far as the LLC with the S-Corp election, so I'm not a CPA, right? I strongly recommend that y'all go and get one. That's just not my skill set, right? But at the same time, I'm very aware of those things that save me money, okay? And with the LLC, there's a cap to how much stuff that you can write off. So when you have a traditional LLC and you elect it as an S-Corp election, by identifying your LLC with the S-Corp election gives you additional tax shelter, and it opens up the amount of additional things that you can write off for your business, okay? Specifically if you're a real estate investor as well. So that's to get more granular into that in terms of tax code, that's not my lane. That's more of a CPA question. I would highly recommend everybody in this room, if you're going to go out and really pursue this business at the level that I believe everybody here wants to, that you need to start moving from a tax practitioner to a CPA, a certified public accountant. Myself and my accountant, we meet once a quarter. We talk about strategy. We talk intermittently as I got, different ideas in terms of what I want to do, and things that I want to pursue, and make sure that I'm already getting out in front of what type of tax savings can I have based off of whatever that business move is, right? So they become an ally in your business. Yeah, they're gonna cost you some more money, but they're gonna save you a lot more money. My CPA, he paid for himself 10 times over with the amount of savings that I get as I make more money. And so I just encourage everybody to move into that space, because tax practitioners, a lot of the time, they're they're not specialists, right? Let's just call it what it is, right? It's the difference between somebody that's out there just doing real estate, right? Hustling real estate versus learning the fundamentals and learning how to operate a business and all of the stuff that y'all learning this week. So it's just a difference, right? And it's important that you align yourself with that individual, because they will increase your bottom line from year to year. When people get mad and they're like, oh, Trump ain't paying no taxes, all these big boys not paying taxes, because they got great CPAs and teams of them that know the tax code intimately. That only so let me just say this. Y'all do realize that people that go to work every day pay about 51% in taxes. State tax, FICA tax, property you pay about 51% of your income in taxes. When you become a business owner, see, when you go to work, you pay your taxes every check. So you paying taxes all year up front, and then in February, you get excited because you got a tax refund, but that just means you overpaid all throughout the year. They just gave you your money back while they held it all year. As a business owner, you get to go out and produce income all year long and then pay your taxes net of fees at the end, right? So you got a ton of opportunity and runway to absorb all of your tax ramifications as you continue to build more expenses throughout the year. And if your CPA is good, as I'm suggesting, they're gonna be able to show you how to maneuver around a lot of that. Okay, so even if you currently are W-2 employee, I'm not knocking that, right? I was at one point as well before I retired, but I always had a business. So even with my W-2 income, I was able to offset that by expenses in my business, because the LLC is a pass-through entity, which means that your income flows through it, right? It's a limited liability company, so it's limiting your liability personally, but as it pertains to revenue, your money flows through the pass-through entity and then back to you personally. So you can have 10 LLCs, but all your revenue pass through them and they come back to you personally, which means that your expenses also run through and come back to you personally. So if you're making $100,000 at work, but you got $170,000 right off in your business, by the time it come back to your W-2, you're now offsetting your income, which is going to put you in an advantageous spot to not pay taxes. And in a lot of cases, you get a refund.
The question that I had, I wanted to know if you could elaborate a little bit more on, like, if you have like equity in your home, how could you use that? Because I know you mentioned something about that yesterday, like the, what is it, the home equity line of credit.
Yeah,
Like, I don't know
absolutely.
yeah, could you
A-
elaborate more on that? How would that work to, our benefit?
absolutely. So, it's interesting. We just had probably three or four of our apprentices who recently did HELOCs in the last 3 or 4 weeks, actually, because many of them had capital in their properties that they wanted to deploy. So essentially, you go out to a traditional mortgage company, right? Somebody that you can go to for a loan for your primary residence, and see if they have a home equity line of credit program, a HELOC program. Many of them do. I would say probably, north of 80, 90% of them do have this product. And then the process is essentially as if you were applying for a loan, but it's less paperwork, it's less arduous. And what happens is, once you go through the initial intake, they'll order the appraisal. Once they get the appraised value back, that's what everything is really predicated on at that point. What does the appraisal come back at? So, if you got $100,000 property is worth 200,000, the appraisal comes back at 200,000. They say, okay, based on what you owe, and let me clarify that point. Equity is the difference between what you owe on the property and what the property is worth. Okay, so if you owe $100,000 on your property, right? You got a current mortgage that you owe $100,000, and the property appraises at 200,000. The difference between the two is your equity. Okay, that's how they come up with that number. So if your property is free and clear and it's worth 500,000, then you got $500,000 worth of equity. Okay, so predicated on how much equity you have, most lenders, based on credit rating and things of that nature, will give you 80% of the equity, not of the value, but of the equity. So in a case where you got $100,000 worth of available equity, they will give you up to $80,000 of that. And essentially it's like a revolving line of credit. And, a lot of people, talk about cash out refinance and things of that nature. In my humble opinion, it's better to use those type of models on investment properties because you can manipulate your yield on those properties.